I mean, you think about the small caps versus the S&P 500, 9 straight days of outperformance. We haven't seen that in years. And I don't necessarily know what the catalyst is right now, because for so long, it's just been a bet on the Fed lowering rates.
All right. Well, let's pose that question to our next guest here. Maybe he sees a little bit more of a reason for those moves. David Bahnsen is the Chief Investment Officer at the Bahnsen Group. He joins us here in Studio 2 with just about 9 minutes until the closing bells. Can you actually explain kind of the newfound interest in a lot of these small and mid-cap stocks?
Yeah, here's what I would say. The most important thing is that the market never needs a reason. And so we can talk about what the reasons are. I think a lot of them are just gravity related and the pull of certain relationships getting so distorted. The big cap and small cap relationship was way off. It can stay off for a long time. It did. This didn't start this year. Katie's right. I think 9 days in a row, she said. That doesn't happen often. But this was happening a lot in December. Not 9 in a row, but 6 on, 4 on. I mean, you got a trend going there. It's not just small cap either.
Okay.
It is the even weighted versus cap weighted. It is value versus growth. It's some of those out of favor sectors. And the correlations within the market right now have got to be very, very low, because I'm seeing things on a screen. It looks like today we're going to end up being somewhat flattish. S&P 20 to 30 bips. There's tons of names up 3, 4, 5%.
Well, this funny thing is about that, as much as we kind of nitpick and scrutinize this, there are a lot of people who say this is actually a good thing, right? To a certain extent, this is how a healthy market should actually be operating.
Yes, it's been a theme of ours for a while, a rotation, not a correction. So much of our time as investors since the financial crisis has been in risk on versus risk off periods. A correction hurts everything. A rotation just simply means a change in leadership. If we were to look at the trailing 12-month returns on Mag 7, people would be shocked at how low they are, besides NVIDIA and Google. I mean, you're talking about low single-digit returns in some of these names.
Oh, I've looked. Yeah,
it is a good point that, we tend to talk about tech as a monolith, but there's been a lot of dispersion there, especially if your name isn't NVIDIA. But that being said, how are you feeling about big tech, the state of the AI trade? Because it seems to be wobbling a little bit over the past few weeks, or at least there's been more questions as to how long this can run.
Well, look, NVIDIA's high was October 29th. It's a few months now, and I think you're going to end up looking at very muted returns in 26, best case. It also will be a high dispersion of results. You notice now all of a sudden CoreWeave has rallied again. Oracle is still way down from its September high. That's what I expect, is you're going to see some winners, some losers, because people have to get off of this idea that they're all going to win. That was always a ridiculous idea. This is really a trade that people have to start looking at with the specific ingredients. And I think there's a lot of question about the circular funding model out of AI CapEx.
Yeah, certainly. And those questions are going to be coming back to the forefront as we get deeper into earnings. But let's talk about potential winners here, because that's a lot of fun. I see in your notes that the energy sector, in your view, a solid contrarian play in 2026. Tell us what you're seeing there, because I feel like energy is one of those sectors that if you're a tourist, if you're not like a pure play energy investor, it's easy to get overwhelmed.
Well, look, my point with being contrarian here is not that it will be the top performing area. It's that when people leave it for dead, it can be a very surprising performer. The last time energy was 2.9% of the entire S&P, when it spent most of my life being 10 to 15%, was in 2020, and it proceeded to then go up 120%. The sector is just too low weighted within the overall market. So whether it's upstream, midstream, combination across energy, I think you get a repricing that's attractive for investors this year. We've already seen it a little bit. So some things have priced up quite a bit. The integrateds, your Exxon, Chevron, some of this is Venezuela related. But no, the midstream area continues to have really attractive yield spreads.
I am curious just about the general nature of geopolitics. You mentioned Venezuela. There's a lot of things going on. I know they haven't had a huge impact on the market, at least not a lasting impact on the market. But do you sort of factor that into, I know you're kind of a bottom-up fundamental investor, but when does it become a bottom-up fundamental kind of story, some of these issues?
Because the top-down geopolitics does affect bottom-up.
Yeah.
And so that's the area that we as portfolio managers have to look to. Chevron there is a good example. We want a base case case where we like the valuation, and then you look for things that we might want to weight it a little higher in terms of some of those particular top-down issues. Chevron's going to be a winner out of the Venezuela story. They were already reasonably priced. Both Exxon and Chevron, I think, made acquisitions during COVID that have never really gotten priced in. It took a little while to integrate, but between Noble and then Hess, Exxon as well, their balance sheets always enable them to pick up market share. They benefit from that, not for a year, but for 10 years.
Yeah.
And so there's a lot of benefit in the integrated. But I would argue the midstream's the story no one's talking about. People love to hate midstream.
Yeah. And I mean, and the thing with Venezuela, I mean, you can sort of draw a line as to who potentially benefits from that, whether you agree with what's going on politically. Similar story when it comes to what's going on in the defense space because of some of the conflicts overseas. But come back home here in the U.S. and all of the talk right now about Fed independence, this idea that no matter who's sitting in that chair come June, at the June meeting, that he or she is going to be way more dovish by default than Powell, or at least the perception, than Powell was. Do you worry at all about the decision-making process at the Fed based on all the politics around it?
It's not so much that I don't worry about it as much as I've already accepted the fact that this president gets to pick the next Fed chair, and this president is not going to pick a Fed chair who is not going to cut at least twice after they come in. And so we know that.
Always a reminder, too, he also picked the current Fed chair.
That's exactly right.
I know he doesn't think you did, but he did.
No, he did. And that, to me, reiterates my point as to how in his mind, I'm not defending it because I'm very much against the way the president has handled all this. But in his mind, he feels, I made that mistake, I won't make it again.
Gotcha.
Ultimately, I believe that Fed independence is a very important thing. There's a lot of issues here that complicate it, but he's not going to fire him. Yeah. And whoever is there is going to cut rates, I think, twice in the second half of the year. That's already in the Fed futures. The bigger question is the year after. Okay, when that immediate political expediency is not as intense, and then we have different data that may or may not call for a different action, I don't think you're going to do a lot of damage taking 50 more out of the curve. But if you are cutting once you're already near around the neutral rate, around 3-ish, right, and if you are at good GDP growth, to me, if they're cutting next year, you better be in recession.
Well, that's something I wonder about, what the market reaction function looks like. Because, okay, let's say we get 2 cuts next year. Let's put aside what happens the year after that because there's so many unknowns. But let's say we get 2 cuts next year. There's no guarantee that, the long end of the Treasury curve is going to cooperate and move lower. I mean, we saw that last September as well. The Fed came out with a jumbo rate cut and the long end shot up. So if the economy, if the data is in a place where it doesn't support those at least 2 cuts, how do you think the market reacts?
Well, the Fed should not be cutting based on trying to control the long end of the curve. The Fed's job is not the long end. The long end is telling us what the economy is doing. The 10-year is the best barometer to measure expectations for nominal GDP growth we've ever had. And the reason we're around 4% right now has nothing to do with the Fed on the 10-year. It's because inflation is 2 to 2.5-ish, and real GDP growth is 1.5 to 2-ish. That's basically the math of this. I think the 10-year is going to do what it's going to do, and there's no central bank I've seen that's been able to control the long end. So that isn't really going to be the issue. The short end, though, is where you can do a lot of distortion in asset prices and create malinvestment, create bad decisions because they've overstimulated with the short end.
All right, David, always great to get your insights.
Thank you so much.
David Bahnsen, Chief Investment Officer over at the Bahnsen Group.